Stock pickers fall mainly into two groups. Fundamental analysts study a company to estimate its value. They'll explore past results and build forecast models to estimate next year's sales and profits. These fundamentalists research a company's products, customers and competitors to predict its future. They believe that financial statements are the best guide to a company's prospects. Chartists, who are also known as technical analysts, believe fundamentalists are wasting their time. From their point of view, the only factor that moves a share price is the supply and demand of a company's shares on the stock exchange. The Chartists study graphs of a company's historical share price to predict the future price of a share. They believe past price movements tell you all you need to know. Fundamentalists analyse a company's balance sheet, income statement and cash flow statements to arrive at its fair value. Fair value, which is sometimes referred to as intrinsic value, is then compared to the company's current share price. The hard graft put in by fundamental analysts is rewarded when they identify a stock which is mispriced. A very important implication underpins their approach. An analyst who tells their clients a stock is mispriced is simply saying its price is incorrect. To make this bold assertion, they must believe that the stock market does not always value stocks correctly. So let's explore three very important phrases used by fundamental analysts: undervaluation, overvaluation, and fair valuation. It's vital that you understand these three phrases: undervalued, overvalued, and fairly valued. The three examples coming up will show the difference between these very important investment concepts. Let's begin with undervaluation. The current share price of a company is €540. In fact, the share price will be €540 in all three examples. Your estimate of fair value, derived from your fundamental analysis, is €600. You believe that there is undervaluation of €60. That's the surplus between your fair value and the current share price. This suggests a potential upside of 11%, found by dividing the difference by the current share price. You'll rate this stock as a buy because it appears too cheap. Now let's take overvaluation. The current share price remains at €540, but your estimate of fair value is €410. You believe there is overvaluation of €130, which is the shortfall between your fair value and the current share price. This suggests a potential downside of 24%, found by dividing the difference by the current share price. You'll rate this stock as a sell because it appears too expensive. And finally, let's look at fairly valued. The current share price is €540, which is exactly the same as your estimate of fair value. There's no under or overvaluation and therefore no potential upside or downside. If you don't own this stock, there is no compelling reason to either buy or sell it. And if you already own this stock, the best thing you can do is hold. The total value of a company in the stock market is given by its market capitalization. Everyone shortens this to market cap, so we'll do the same. Market cap is easy to calculate. It's found by multiplying the number of shares in issue by the current share price. So a company with 100 shares in issue and a current share price of €24 has a market cap of €2,400. The market cap changes when either the share price or the number of shares changes. Imagine watching a trader's screen. The share price for a listed company may change every second. Each change will move the market cap. A rise to €25 puts the market cap up to €2,500. That's 100 shares times the share price of €25. But a fall to €23 means the market cap slips to 2,300. That's 100 shares times the share price of €23. The number of issued shares changes with far less frequency. A new issue or a buyback will change the market cap even though the share price hasn't moved. Now remember those phrases: undervaluation, overvaluation, and fair valuation. The fundamental analyst searches for these by comparing market cap to book value. In the following page, you'll see how this works. Here are two examples where we compare market capitalization to book value. It's important to remember that while the market cap changes all the time, book value at a listed European company is only released every 6 months. It's an item we find in the printed accounts. Underpinning these two examples is your belief that a company's market cap should be equal to its book value. Undervaluation. You see that market cap is below book value. You calculate an undervaluation of €3,000, which indicates a potential upside of 25%. The share price is too low, so you could therefore buy these shares. Overvaluation. The market cap has risen over the book value. The downside is 12%, and so the share price appears to be too high. Typically, you'd sell these shares. A trend indicates the possible direction of a share price. A technical analyst studies historical charts to predict where a share is heading. Let's start with an easy example. Here's the chart for a Norwegian company whose shares have risen from 180 Norwegian kroner to 280 between April the 1st and July the 9th. What do you think the trend tells you? Over the last 100 days, the stock has risen 56%. That's 100 divided by 180. There have been a few dips, and the period between May the 13th and June the 3rd looks a bit flat, but overall the general trend seems to be up. A fundamental analyst would attempt to find out why buyers believe the stock is underpriced. The technical analyst wouldn't make these calculations. He believes the trend is your friend and is the best guide to future share prices. The price of this Norwegian company is rising simply because there are more buyers than sellers in the market. But what else might give us additional understanding? In the next video, we look at adding more information to the chart. Now we add some information to the chart: trading volume. This refers to the total number of shares in a company traded in a day. It's a vital concept for Chartists because it tells them a lot about the strength or weakness of a trend. We know that the average daily trading volume for these shares over the 100-day period was 10,000. Trading volume is the total number of shares in a company traded in a day. It's a vital concept for Chartists because it tells them a lot about the strength or weakness of a trend. The analyst has noticed something interesting about the trading volume at 2 points. On April the 22nd, point A on the graph, average daily volume rises to 20,000 and stays that way for several weeks. On June the 17th, point B, the average daily volume falls to 5,000 and continues to decline. How would these 2 points affect your investment decision? At point A, the increased trading volume indicates a strong trend. The share price is rising and there are plenty of investors who want to buy the stock. We can buy with confidence at this point. But at point B, there are far fewer investors buying. The trend still points up, but there is less support for the rise. Investors will still regard this trend as a buy signal, but will be more cautious about their decision. They might delay buying because the trend appears weaker. Fundamentalists ruled the investment world for decades. The Chartists only started to appear at major banks in the 1980s, and for a long time the two camps battled for supremacy. Fundamentalists pointed to the big gains they've made by digging deep into a company's accounts. They criticised Chartists for their lack of company knowledge. Chartists believe that the market price is correct, so looking at fundamentals was pointless. They said the fundamentalists were wasting their time in their quest to uncover cheap stocks. So what do smart investors do? Well, they combine both approaches. For example, they use fundamental analysis to find a stock which looks undervalued, and then use technical analysis to identify the best time to buy it. Let's review what you've learned. We looked at two groups of investors. Fundamental analysts study a company to estimate its value. They analyse a company's balance sheet, income statement, and cash flow statement to arrive at its fair value. Fair value is then compared to the company's current share price. They believe that financial statements are the best guide to a company's prospects. Chartists believe that the only factor that moves a share price is the supply and demand of a company's shares on the stock exchange. They study graphs of a company's historical share price to predict the future price of a share. They believe past price movements tell you all you need to know. The fundamental analyst searches for undervaluation, overvaluation, and fair valuation by comparing market cap to book value. The technical analyst will look for trends. A trend indicates the possible direction of a share price. They study historical charts to predict where a share is heading. Fundamental analysts have the long term in mind. They often follow a buy and hold strategy. Chartists are far more likely to be short-term traders. They might buy and sell shares on the same day, even in the same hour. And remember, what do smart investors do? They combine both approaches. They use fundamental analysis to find a stock which looks undervalued, and then use technical analysis to identify the best day to buy it.